Okay, let's get some reaction to the FOMC's meeting from Rob. Rob, I mean, bottom line, at least the highlight from this seems to be the FOMC is ending its $300 billion Treasury purchase. It'll do so by October, which is a month later than planned. Your reaction to that?
Yeah, look, I think it's an interesting point. Certainly, the Fed was overdue making some sort of comment on the ending of quantitative easing. I guess you can really read it both ways. For me, I am still concerned about the lack of increase in loans we're seeing from the commercial banking system in the U.S. Essentially, the loan market is still weak, and it was interesting listening to the previous segment talking about activity in the mortgage market in the U.S. You know, it just doesn't seem to be the case that we're seeing a tremendous increase in the turnover of loans. Yes, the banking system is very flush with liquidity, but it doesn't seem to be putting it to good use. The level of loans, particularly for commercial and industrial, would be running at some of the lowest levels that we've seen since the first quarter of last year. And total loans from commercial and industrial banks in the U.S. would be running at the lowest levels in an absolute sense since May of last year. To me, I think that's a good argument for the Fed actually being fairly slow. Of course, they need to give us a clear indication when quantitative easing is going to end. It's very important for the U.S. bond market. It's very important for U.S. financial markets. But an important consideration for the Fed is that even though we're seeing signs of stability in the economy, the pace of turnover of money, developments in the banking system really don't suggest that they're going to be able to pull that QE out of the financial system anytime soon. So I actually read it as a sign that the Fed is probably being slightly reluctant. It's trying to very quietly put back QE without leaving the market concerned about devaluing the US dollar. To me, I expect to see more of that in coming FOMC statements.
You know, the data out there suggests that economic activity is leveling out, is what the Fed had to say, but the economy will remain weak for a time. So that backs up what you were saying. Bottom line, though, just briefly, Fed balance sheet expanding by $1 trillion so far. It's going to have to reduce that quite slowly, is what you're saying.
Absolutely. You know, again, money is not multiplying. The whole idea of quantitative easing is that you force more than enough money, more money than anybody wants into the banking system. You step back, you give it a bit of time, you let it multiply, and then it develops into underlying strength in the economy. Now, the Fed is doing that. It's pumping that money into the system. It's doing aggressively by going out and buying mortgage-backed securities, agent securities, treasury securities. It's flooding the system with money, but money is not doing what money should be doing, and that will take more time. So I think it's still going to be a long time before we really see the orderly unwind process coming through.
Rob, we're going to take a quick break. When we come back, we're going to take a look at the impact on currencies with Rob Rennie. Now, welcome back to our regular currency chat. I'm joined by Trish Louie in Singapore. We also have Rob Rennie, Westpac Banking Chief's currency strategist. If you have any Forex trading questions, of course, email us. The show email is tradewithhas@bloomberg.net. Tradewithhas@bloomberg.net, or simply message the trade on your terminal. And we have quite a few which have been heading away already. Trish has those. Trish.
Hey, Rob, we have one viewer email here from Stefan. He's asking you about the Fed says it will end the Treasury buying in October, and can you elaborate on the possible outcome on the dollar? Now, because we had the quantitative easing ending in October, which it should be dollar positive, yet we have the encouraging FOMC statement on the U.S. economy, which is risk appetite bolstering, which actually weighed on the dollar. So can you elaborate, please?
Yeah, look, a really good question, and I think it's important to note that that the relationships that we're seeing between risk, between quantitative easing and the dollar, etc., are really shifting around quite a lot. We've seen a tremendous amount of volatility in FX markets since the non-farm payroll report on Friday. The environment that I think that we are heading into is one where we can actually see better U.S. data helping the U.S. dollar. For the last year, we've been in a situation where terrific or much better than expected data, particularly over the last 6 months, coming out of the US has actually hurt the US dollar. And that's because of this sort of risk-on, risk environment that we've been in for the last year. I think we're beginning to shift. To me, the strength and the beginnings of improvement that we're seeing in the US economy vis-a-vis the European economy are so clear and so obvious to the markets that we will actually see a bit of a shift back towards normality, whereby better US data actually helps. The only concern that I have is, and as I mentioned in the earlier segment of this program, that if the Fed delays removing QE, if it tries to sort of push it back slightly through the tail end of this year and into next year, that's something that would then reignite this sort of debate over whether you're trying to debase the value of the US dollar. That's an important debate. I think it's a debate that we'll see more of. But for me, if I look at currencies like euro, you look at the reaction that we had on Friday, 144.5 very, very briefly, and then we collapsed from that point. Cable, gains up towards 170, and then we come under significant pressure. I think we've gotten to the point where the market is diversified away from the US dollar enough. I think the fundamentals are showing signs of improvement, and that to me probably will benefit the US dollar in coming weeks in a bigger picture sense.
Right, we have another question here as well, a bit related to what you just answered just now. It's from Jeffrey Litzkov. He's saying that can industrial gas see another large unwinding of the currency trade with risk appetite comes back into the market? Now, you just said just now good economic data, US economic data will actually benefit the dollar. Does it mean that the other Asian currencies, emerging currencies, will actually be weaker?
No, that's a very good question. To me, I think you want to sort of you want to almost divide the world into regions that are doing better, regions that were better placed going into this from a balance sheet point of view. And I think one of those regions is actually Asia. Yes, of course, we've seen a tremendous inventory backlog develop in Asia, and that's had a tremendous impact on exports, industrial production, etc., across the region. But Asia didn't have the balance sheets, it didn't have the degree of stretch within the households, it didn't have the degree of stretch within the banking system. To me, Asia is actually better placed to recover, and it's better placed to embrace the recovery or the beginnings of the recovery that we're seeing in the US. So I'm less downbeat. I think a positive risk environment can actually help the US dollar in a bigger picture sense versus the major axes, sterling, euro, etc., even versus CAD. But I think that the impact from an Asian point of view and an Australasian point of view, I think those currencies, the Aussie, the Kiwi, and the Asian currencies are actually fairly well positioned to hold their own at the moment.
Rob, one of the views out there on the way different governments are handling trying to keep their economies afloat. Bank of England trying to basically keep money supply, maintain money supply growth or keep it stable, whereas the US has been trying to keep long-term interest rates lower. Does that have much impact on those particular currencies and how you would play them?
Look, I think it does. To me, I think we've got an interesting development in the debate on sort of monetary policy, whether it's Fed style or Bank of England style, and fiscal policy. To me, if you want an example of an economy that's done very well in terms of managing both fiscal and monetary policy together, it's the Australian economy. We saw very, very targeted fiscal policy towards the household, towards the consumer, and we're seeing significant recovery in consumer sentiment. We've seen retail sales, the housing market generally do much better than expected. There's differences, obviously, between the Australian economy and the US and UK economy, but to me it's a very good example. Now, tonight, we'll get retail sales out of the US, and we'll get evidence on the success or failure of the cash for clunkers. To me, that's an interesting one to watch. We expect to see a very strong pickup in headline retail sales, courtesy of monetary policy and fiscal policy, but the core numbers we expect to see much less strength. So to me, the debate is not so much whether UK monetary policy or the Fed is correct. To me, it's whether the balance between fiscal and monetary policy is correct. And again, I think we get an important update on that process tonight in US retail sales.
OK, Rob, thank you very much indeed for your time today. Rob Rennie, Chief Currency Strategist at Westpac Bank. Also, of course, Trish Louis in Singapore.